Hello everyone, Christian here. I hope you're doing well. Bitcoin just printed one of the most deceptive weeks we've seen in months. We had massive ETF inflows at the beginning of the week. Then inflation fears hit the market. Bitcoin temporarily lost $80,000. Over-leveraged longs got wiped out. And now Bitcoin is sitting directly underneath major resistance again. But here's the important part. The market actually warned us this was likely coming before this week even started. And what's even more interesting, traditional markets were showing the exact same warning signs. So in this video, I'm going to break down what happened this week, the technical warning signs that predicted this move, what institutions are likely doing behind the scenes, where liquidity currently sits, the key levels you need to watch, and the most probable scenario moving forward. Let's get into it. Now, it's important to understand that the market already showed warning signs between May 6th and May 10th. Bitcoin was forming a bearish divergence on the RSI. And this is critical because while price was making higher highs, the RSI was making lower highs. Meaning momentum underneath the surface was actually weakening while price kept pushing upward. This is one of the most common warning signs before corrections, fake outs, or major liquidity sweeps. But at that time, most retail traders ignored it because sentiment was becoming extremely bullish. Everyone was focused on Bitcoin to 100,000, new all-time highs, institutions are buying everything. But technically, momentum was already weakening according to the RSI, and the MACD confirms it. Now, what makes this even more interesting is that Bitcoin was not the only market showing weakness underneath the surface. Between April 17th and May 1st, SP 500 formed a bearish divergence on the RSI. Price continued pushing higher, but the momentum underneath the surface started weakening. Then on May 13th, the RSI confirmed the loss of momentum as it started rolling over lower. And this matters because Bitcoin and traditional risk assets have been highly correlated during macro uncertainty periods. So when SP 500 started losing momentum, Bitcoin followed almost the exact same structure. That tells us this wasn't just random crypto volatility. This was broader market risk appetite started to weaken. And when both SP 500 Bitcoin show bearish divergence, weakening RSI, and slowing momentum at the same time, that significantly increases the probability of pullbacks, liquidity sweeps, and volatility expansions before continuation higher. So heading into the week beginning May 11th, both traditional markets and crypto were already showing signs of momentum exhaustion. And then inflation data became the catalyst that triggered the reaction. Bitcoin started the week holding above the $80,000 psychological level. At this point, momentum still looks strong on the surface. Spot Bitcoin ETFs had already recorded multiple consecutive weeks of positive inflows, with BlackRock's IBT continuing to dominate institutional demand. This matters because ETF demand creates real spot buying pressure. Unlike leveraged traders, ETF buyers are absorbing actual Bitcoin supply from the market. That structural demand is one of the main reasons Bitcoin managed to reclaim the $80,000 in the first place. On Tuesday, 12th of May, the market started showing weakness. Price stopped trending aggressively higher, yet leverage kept building underneath the surface. Funding rates started climbing, open interest increased, and traders became aggressively long biased. This is dangerous because when leverage builds faster than spot demand, the market becomes vulnerable to liquidation events. Wednesday, 13th of May became the major macro event of the week. The United States released hotter than expected inflation data. Producer inflation surged, which increased fears that the Federal Reserve may keep interest rates higher for longer. And markets reacted immediately. Bitcoin sold off aggressively at the price of $79,000 approximately. Price briefly lost the $80,000 level. Long liquidation accelerated across exchanges. More than $200 million in long positions were liquidated very quickly. But here's what matters the most is that Bitcoin did not collapse. Buyers stepped in aggressively under near support. And this is critical to understand because strong markets absorb bad news, while weak markets break down from it. And then on May 13th, we got additional confirmation from the MACD. The MACD line crossed below the signal line while still above the zero line. Now, this is important because crossover above the zero line often signal momentum reversal from strength, not from weakness, meaning the market was losing bullish momentum while still sitting at elevated prices. And when you combine a bearish RSI divergence, overheated funding, RSI open interest, and a bearish MACD crossover, that creates a very dangerous environment for rate longs. especially when macro uncertainty enters the market at the same time. And honestly, this is exactly what we're seeing right now. On Thursday, 14th of May, after the liquidation flush, Bitcoin started stabilizing again above the $80,000. This is where we started seeing the real battle between leverage traders and spot demand. Retail traders were panicking because of macro uncertainty, but institutions did not disappear. ETF demand slowed temporarily, but structurally, institutional participation remained strong. And that's a major difference compared to previous bear market conditions. By Friday, 15th of May, Bitcoin was still struggling underneath major resistance around $82,000. And this tells us something very important. There are clearly large sellers active above current price. At the same time, buyers continue defending dips aggressively underneath 80,000. This creates what I call a liquidity compression environment, meaning the market is building pressure for a larger move. Saturday 16th gave us the clearest warning sign of the entire week. Price action turned decisively bearish. Bitcoin continued fading to reclaim resistance, lower highs started forming, and momentum completely slowed down. This matters because markets that are truly strong usually reclaim resistance aggressively after liquidation events. Bitcoin failed to do that. Instead, the market looked heavy. And when price starts looking heavy underneath resistance, it often means larger players are distributing into relief rallies rather than accumulating aggressively. At this stage, bulls are losing short-term control. Now, moving into Sunday, the market is showing hesitation. The daily candle is currently forming a doji candle, and for those unfamiliar, a doji candle represents indecision. It means neither buyers nor sellers are fully in control right now. After a bearish move, a doji candle becomes extremely important because it often signals one of the two things. Either the market is preparing for continuation lower, or the market is pausing before a larger reversal attempt. But what matters most is context. And in the current context, with Bitcoin struggling below resistance, failing to regain momentum and sentiment still relatively optimistic, this hesitation leans more cautiously bearish unless bulls can quickly reclaim strength. So right now the market feels uncertain, fragile, and highly reactive to liquidity. Now coming into today, Monday 18th, Bitcoin is seeing a very important decision point. Above current price, there's a major short liquidity sitting above 81 to 82,000, even though there's a major presence here around $78,000. Below the current price, there's still a large long liquidity sitting under near $77,000, meaning the market still has incentive to attack both directions. Now let's talk about what institutions are probably doing behind the scenes, because this is where most retail traders misunderstand the market completely. Retail traders see price above 80,000 and think, oh, Bitcoin only goes higher from here. But institutions think differently. Institutions think about liquidity. This week created perfect conditions for liquidity harvesting. Retail traders became aggressively bullish above resistance. Funding rates climbed, leverage became overcrowded, then inflation fears triggered panic. This allowed larger players to sell into breakout excitement, then accumulate panic, selling lower. This is why price action felt so manipulative this week. Now, if we look at the liquidation heat map for the entire week, you can actually see how price moved almost perfectly between liquidity clusters. Bitcoin pushed upward and attacked short liquidity above $82,000. Then after leverage became overcrowded, the market reversed aggressively lower and started liquidating longs underneath the 80,000. This is exactly how institutional markets operate. Price moves toward liquidity, not toward what retail traders emotionally want. And this week, the market repeatedly targeted the largest liquidation zones on both sides. Now, if we zoom into the 24-hour liquidation heat map, based on the current momentum structure, the lower liquidity zone actually looks more attractive to the market, especially because RSI still has room to move lower and MACD momentum is still bearish and funding remains vulnerable to another flush. So unless Bitcoin reclaims resistance very quickly, I would not be surprised to see price continue hunting lower liquidity before a meaningful reversal happens. So where does the market currently stand? Right now, the higher time frame structure still remains bullish overall. Bitcoin is still holding significantly above the major lows. ETF participation remains historically strong, and buyers have continued defending key support zones despite macro pressure. However, short-term momentum has clearly weakened. And price continues struggling underneath the major resistance around $81,000 to $82,000, particularly on the 79,000 resistance line. So at this stage, the market is essentially sitting in a compression environment, meaning the next major move will likely come from whichever side loses control first. If weakness continues, the market might rotate lower into remaining liquidity zones before attempting continuation again. Honestly, that's the most important thing to understand right now. There is no longer a market where certainty exists. This is now a reaction-based environment. The market is waiting for confirmation. Overall, this week showed us something extremely important. Bitcoin handled macro pressure surprisingly well. Institutions slowed down temporarily, but did not disappear. And leverage became overcrowded again. That combination usually creates volatility before continuation. So now the key question becomes, does Bitcoin reclaim resistance and squeeze higher? Or does the market punish late longs first before the real move begins? Let me know what you think in the comments, and if you found this breakdown valuable, make sure to subscribe, because every week we break down exactly what smart money is likely doing behind the scenes. I'll see you in the next one.